Hi, I'm Mike Clusta with the Motley Fool. Everyone is focused on stocks right now, but another market has far graver risks. Joining me to talk is Dan Kaplinger. Hi, Dan.
Hi, Mike.
So where's the biggest risk to investors right now?
Everybody's looking at the stock market right now, especially since it's been down so sharply this past week. But the greater long-term risk is actually in the bond market because the risk of interest rates starting to rise as the economy recovers is really great. A lot of investors don't even realize it, but bonds can actually lose value when interest rates rise. And I think that a lot of investors aren't prepared to see the losses in their portfolios that could result from higher rates in their bond portfolios.
It sounds like a definite risk. What could cause a bond market collapse?
Well, the first step is for the economy to start recovering more strongly. At that point, there's going to be upward pressure on interest rates, and the Federal Reserve is going to be pressured to go ahead and allow those rates to start to rise. That in turn is going to hurt bond prices. It's also going to hurt companies that have relied on low interest rates. Some of the most popular are mortgage REITs, companies like Annaly Capital, like American Capital Agency that have profited from those low rates. They could see declines in dividend yields that could really hurt their investments.
Yeah, that could be a serious problem. So what should bond investors do?
Well, the key to surviving as a bond investor in a period of rising rates is to keep your investments short term if possible. Unfortunately, that's not what a lot of bond investors do. They tend to favor ETFs with really long exposure. ETFs like the iShares Barclays Aggregate Bond, like the iShares 20 plus year Treasury Bond, those are going to take some of the biggest losses. On the other hand, if you decide that you want to bet on the direction of bond prices falling, there are somewhat dangerous ways that you can get trapped. And I really don't recommend that people use the leveraged ETF, ProShares Ultra Short 20 plus year Treasury Bond ETF. That's just too risky a move. Even if bond interest rates start to rise, that could still be a problem.
Excellent. Great information. Thanks, Dan. If you want more information about bonds, make sure to visit us at fool.com. Fool on.